Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Venture Global.
If you find our talks useful, please consider subscribe, like, and comment underneath.
So, let's jump right in, right?
Yeah, let's do it. So I want you to imagine a startup, right? Like building a product in a garage.
Okay, classic Silicon Valley story.
Exactly. They are, burning through venture capital, trying to piece together something massive.
Right, and everyone is just wondering if they will ever actually turn a profit.
Right. But now imagine that practically overnight, they flip a switch.
Oh, wow.
Yeah, and suddenly they're generating like $13.8 billion in revenue
That's insane.
with Fortune 500 profit margins.
You'd assume their stock would just be touching the moon at that point.
They would. You really would. But today's company, this infrastructure powerhouse named Venture Global, their stock has actually been cut entirely in half.
Half. Wow. So the fundamental reality of the business is like pointing straight up, but the valuation is just sinking.
Exactly. It's a total paradox. And that's our mission for this talk, to figure out why this massive disconnect exists.
Right, and whether this contradiction creates, a rare sort of coiled spring opportunity for your portfolio.
Yeah, because, the market absolutely hates cognitive dissonance.
Oh, it really does. When the operational numbers tell this story of explosive historic growth, and then the stock price tells a story of panic, well, something eventually has to snap back into alignment.
Right. One side is wrong. And we have to start with the operational numbers because, honestly, they are hard to wrap your head around.
They really are.
Looking at their full year 2025 financial results, the leap is just extraordinary. Top-line revenue hit $13.8 billion.
Which is what, 177% increase year over year?
Yeah, exactly, 177%.
But, top-line revenue only tells you how much money is moving through the door.
Right, anyone can buy revenue.
Exactly. A lot of companies can, like buy revenue growth by slashing prices or taking on just massive debt.
But they bleed cash in the process.
Exactly. The fundamental paradigm shift here is what Venture Global actually kept.
Right, and that brings us to the operating income, which surged 192%.
Oh, wow.
Up to $5.2 billion. And their adjusted EBITDA grew 198% to $6.3 billion.
So the operating income actually outpaced the top-line revenue growth.
Yes. Which tells me they aren't just running faster on a treadmill, They're becoming fundamentally more efficient with every single unit they sell.
It completely validates their entire operational model. They've successfully scaled their margins right alongside their volume.
And the physical scale of this operation is what makes those margins so impressive to me.
Right. We aren't talking about a software company just adding servers in a data center.
No.
We're talking about massive physical global logistics here.
Exactly. They exported a record 380 liquefied natural gas cargoes in 2025.
Pre-80.
Yeah, which is a 170% jump from the previous year.
That's just wild. To go from a pre-revenue construction story to seamlessly loading and shipping 380 massive cargo vessels, it's a masterclass in execution.
It really is. But I want to pause on the mechanics of that for a second.
Sure.
Because the term liquefied natural gas, it gets thrown around a lot.
Oh, all the time.
But people don't really acknowledge the sheer physics involved.
Right. Moving liquefied natural gas is arguably one of the most complex logistical dances on the planet.
Break that down for us. What does it actually take?
Well, you're taking natural gas and you have to supercool it. We're talking negative 260 degrees Fahrenheit.
Wait, negative 260?
Yeah, it's extreme. And at that temperature, it becomes a liquid and it actually shrinks to 1/600th of its original volume.
1/600th. So you're essentially taking a skyscraper's worth of gas and compressing it into a single specialized thermos.
That's a great way to put it. And then you're pumping that volatile, supercooled liquid onto these highly specialized maritime vessels,
Right.
navigating complex global shipping lanes and delivering it to regasification terminals over in Europe and Asia.
And they executed that 380 times flawlessly in a single year.
Without catastrophic delays or accidents, yeah. That is the mechanical reality behind that $6.3 billion in adjusted EBITDA.
Which brings up a massive structural question for me.
Okay, what's that?
Heavy infrastructure is just notorious for delays, right? Budget overruns, years of bureaucratic red tape.
Oh, yeah, always.
We've all seen government projects or corporate mega projects that take a decade just to pour the concrete. So how did they scale a $13.8 billion energy export business this fast?
Well, they actually bypassed the traditional construction bottleneck entirely.
Really? How?
Yeah, and this leads us to what is arguably Venture Global's greatest competitive advantage, their process moat.
Okay, a process mode.
Right? Historically, the legacy competitors in this space, they build massive monolithic liquefaction trains.
Monolithic liquefaction trains. Let's break that down. Are we talking about, like, custom building a gigantic factory completely from scratch?
Yes, exactly. The traditional approach is to clear a massive site along the Gulf Coast, hire thousands of specialized laborers, and just build the entire facility piece by piece.
Out in the elements.
Right, out in the elements. You're pouring concrete in the mud. You're dealing with weather delays, hurricane seasons, local labor shortages,
Engineering headaches.
all of it. It takes years,
Yeah.
and the budget almost always balloons.
So Venture Global flipped the script.
They did. They use a modular construction model instead.
Okay, so instead of building in the mud, what do?
They use smaller, prefabricated modules.
Uh-huh.
They build these critical components off-site in highly controlled, climate-controlled factory environments.
Oh, that makes sense.
Yeah, so they can build them year-round, totally regardless of the weather in Louisiana.
Right.
And then they just ship these completed pieces to the facility and essentially plug them in.
It's like assembling critical energy infrastructure using Lego blocks.
That's exactly it.
You build the pieces perfectly in a pristine factory, bring them to the site, and just snap them together.
And that speed to market is the entire game in this industry.
Because time is money.
Huge money. Every month you shave off construction is a month of recognizing hundreds of millions in revenue.
Wow.
That modular Lego block approach, it allowed them to reach full capacity at their Calcasieu Pass facility and commence their Plaquemines exports far faster than anyone anticipated.
So they basically lapped their competitors.
They did. They grabbed vital market share right when global demand was spiking.
Okay, I hear that, but I have to play devil's advocate here for a second.
Go for it.
If treating a multi-billion-dollar facility like a modular Lego set is so much faster and generates $6.3 billion in profit,
Yeah.
why isn't every legacy energy giant on Earth pivoting to this exact style of construction right now?
Institutional inertia and sunk costs.
Sunk costs.
Yeah. Legacy companies have these deeply entrenched supply chains. They have engineering teams trained for decades in monolithic construction.
Right, they're set in their ways.
Exactly. And they have ironclad relationships with traditional construction firms,
Mm.
pivoting a 100-year-old energy conglomerate to an entirely new paradigm.
It would be a nightmare.
It would require dismantling their existing infrastructure.
They'd have to cannibalize their own operations just to catch up.
Exactly. Whereas Venture Global, they started with a blank sheet of paper and designed their entire corporate DNA around this modular approach from day one.
Which leaves them as this operational juggernaut with a unique process mode, basically printing cash.
Printing cash and capturing market share.
But then I pull up the stock chart, and it completely shatters that whole narrative.
Right. The disconnect.
Yeah, the stock is currently trading around $12.50. That is roughly half of its $25 IPO price.
It's wild.
The business has exploded in size, but the valuation has been absolutely butchered by the retail market.
And this is the tension of the coiled spring we mentioned earlier. When the fundamental business is moving exponentially upward, and the share price is moving violently downward.
Something's got to give.
Exactly. A catalyst eventually forces a correction. And we just saw a massive financial catalyst that suggests the smart money is actually moving in right now.
Okay, let's talk about that. They just closed an $8.6 billion project financing deal.
Right, for the second phase of their CP2 facility.
And that brings the total CP2 financing to $20.7 billion.
Which is massive.
It's the largest standalone project financing in the United States bank market.
We're talking about a consortium of the most rigorous, risk-averse commercial banks on the planet committing nearly $21 billion.
Okay, wait. I have to push back hard on that.
Okay, why?
Because banks make terrible, catastrophic bets all the time, right?
Well,
Look at the 2008 financial crisis with subprime mortgages.
Sure.
So why should you or I view this banking consortium as the ultimate smart money validation? Why couldn't this just be another terrible bet by over-leveraged lenders?
that's a fair question. But the mechanics of project finance are fundamentally different from consumer lending or subprime mortgages.
How so?
Well, in 2008, banks were packaging and offloading risk they didn't really understand, right?
Right, passing the hot potato.
Exactly. But in a $20 billion project finance deal, the banks are holding the risk. And the loan is secured directly by the cash flows of the specific facility.
So they can't just sell it off. The due diligence must be entirely different.
It is excruciating. These lenders, they deploy armies of engineers to inspect the modular construction process.
Wow.
They deploy forensic accountants to audit the long-term contracts. They stress test every possible failure point.
So a commitment of $20.7 billion means Venture Global survived, like the deepest institutional autopsy imaginable.
And passed with flying colors.
And the technical momentum of the stock is starting to reflect that institutional confidence, isn't it?
It is. The stock jumped 4% on the CP2 financing news.
And we are also seeing analysts revise their models. RBC Capital raised their target to $14 with an outperform rating.
Right, and Scotiabank raised their target to $11.
So the broader market algorithms are picking up on this too.
Yeah, the moving averages are stabilizing after a really long downtrend. When you see multiple price target raises following a major financing milestone like this, it typically signals that institutional accumulation is beginning.
The big funds wait for the banks to de-risk the project with financing, and then they start buying the equity.
Exactly.
But, even with the banks de-risking the project, we cannot ignore why the retail market cut the stock in half to begin with.
Right. We have to look at the bear case.
We do. What are the dark clouds hanging over this stock?
Well, the market is weighing two primary risks. And the most immediate and honestly the loudest risk is the legal storm.
Ah, the lawsuits.
Yeah. Venture Global is locked in multi-billion-dollar arbitration battles with some of the biggest European energy giants over contract terms and supply obligations.
Let's dig into the mechanics of that dispute, because it is fascinating drama.
It really is.
This all centers around something called commissioning gas, doesn't it?
It does. So, when a massive liquefied natural gas plant is first turning on, it doesn't just run at 100% capacity on day one.
Right, it has to warm up.
Exactly. Go through a prolonged warm-up phase called commissioning. And during this phase, the plant is producing gas, but the company hasn't officially declared the facility commercial.
And this is where the conflict exploded.
Yes. Venture Global had these long-term contracts to supply gas to these European utilities at a set, relatively low price.
But because the plant was still technically in its commissioning phase,
Venture Global claimed they weren't legally obligated to deliver gas under those contracts yet.
wow. So what did they do with all that gas?
They took that commissioning gas and sold it on the open spot market at massive premiums.
Because global energy prices were skyrocketing at the time.
Exactly. They made billions in windfall profits, while the European utilities were basically left empty-handed, watching Venture Global cash in.
The European utilities must be furious.
Furious is an understatement. And the retail market is terrified of an adverse legal ruling that could force cargo diversions or impose massive sweeping fines.
So the bears are looking at this arbitration and seeing an existential threat to the company.
Right. Retail markets abhor uncertainty, and a pending multi-billion-dollar arbitration is a complete black box.
But we have to synthesize this legal fear with the $20.7 billion banking validation we just discussed, right?
Absolutely. Think about who has the most to lose here.
The banks. If a European arbitration panel wipes out Venture Global's cash flow, the lenders are left holding the bag.
Exactly. The banking consortium has lawyers whose sole mandate is to stress test these specific arbitration scenarios.
Right.
If those lawyers thought Venture Global was going to lose billions in fines, they would never have funded the $8.6 billion second phase.
They'd run for the hills.
Yeah. Their willingness to lend strongly implies that institutional lenders view these commercial disputes as manageable, standard commercial friction.
Okay, that makes a lot of sense. But even if the banks aren't losing sleep over the lawsuits, they must be sweating the commodity market.
Right. Which brings us to the second fear in the bear case.
Yeah, analysts are warning that by 2026 and 2027, a wave of new global capacity is going to come online.
The fear of global oversupply.
Exactly. The fear is a global oversupply that could drive spot prices down to the 9.50 to 9.90 range.
Right.
So if the world is flooded with gas and prices tank, doesn't Venture Global's revenue just collapse with it?
Well, that assumption ignores the fundamental mechanics of their business model.
How so?
It also ignores the immediate macroeconomic reality unfolding right now. The bears are hyper-focused on a theoretical oversupply in 2027, but they're completely disregarding the very real scarcity premium happening today.
Okay, to understand that scarcity premium, we have to look at global supply chains.
Right.
And looking purely at the math of global logistics, and I want to be very clear, we are not getting into the politics of the Middle East conflict itself here, just the economic mechanics.
Purely the supply chain disruption, yes.
Right. The potential closure of the Strait of Hormuz creates a massive bottleneck.
It does. A significant portion of the world's energy flows through that single choke point.
And when navigation becomes dangerous there, it creates a real-time scarcity premium.
Exactly. European and Asian buyers face immediate shortfalls, and they scramble to secure reliable supplies from stable regions.
Which points a spotlight directly onto United States infrastructure.
Yes. So buyers flood to U.S. suppliers like Venture Global.
But how does that protect them from the bears' fear of a price collapse in 2027?
Because Venture Global operates largely on long-term, pre-agreed contracts.
Ah.
It's like securing a fixed-rate mortgage during a period of wild inflation. They act as the bank that has already secured its yield, regardless of market panic.
Right, so when spot prices skyrocket today, their baseline revenue is secure.
And if spot prices drop in 2027, like the bears fear, Venture Global already has those contracts locked in to protect their downside.
So the current global volatility mathematically benefits them.
It does. It drives European and Asian buyers to the negotiating table right now.
Because those buyers are desperate to sign long-term contracts with Venture Global just to guarantee their future energy security.
Exactly, which effectively locks in Venture Global's revenue for the next decade.
Wow. Okay, so the fundamentals are stellar. The legal risks appear heavily priced in by institutional lenders, and their contracts protect them from commodity collapse.
That's the picture, yes.
So what specific milestones on the calendar should you be watching over the next few quarters?
Well, the first major event to watch is in the second quarter of 2026. This is regarding the Plaquemines Phase I commercial operation.
The official deadline for that operation is the fourth quarter of 2026, right?
It is,
Yeah.
but we have to remember their modular construction mode.
The Lego blocks.
Yes. Because they use offsite manufacturing, they have a history of beating construction deadlines.
Oh, interesting.
Any updates in Q2 showing early progress could act as a major immediate catalyst. If they announce they're turning on the spigots early, the market will reprice the equity very quickly.
And immediately after that, we look to the macro environment in June 2026.
Right, specifically regarding potential Federal Reserve rate cuts.
Because a heavily indebted infrastructure company is incredibly sensitive to the cost of capital.
Exactly. When you are servicing a $20.7 billion debt load, the mechanics of a rate cut are profound.
Let's explain those mechanics. How does a minor cut by the Federal Reserve actually impact their day-to-day business?
Well, a portion of infrastructure debt is often floating or constantly being refinanced as new projects come online.
Okay.
So even a 25 basis point cut by the Fed significantly lowers the interest payments required to service that massive debt stack.
Just a tiny percentage point move.
Right, but on $20 billion, it literally frees up tens of millions of dollars that immediately drops straight to their bottom line as free cash flow. It makes their existing debt cheaper to hold and their future projects cheaper to build.
So you have operational catalysts in Q2 with Plaquemines and macroeconomic tailwinds in June with the Fed.
Which is why the analysis gives this setup an 8 out of 10 bullish score.
That is a very strong conviction score.
It is, but the framing is critical here. This is not a quick day trade. This is viewed as a 12 to 18-month long-term buy.
Right. The strategy is to hold through the resolution of the legal noise with the European energy giants and ride it into the Plaquemines milestone.
Exactly. Looking at the current trading range of $12 to $13, it offers a highly favorable entry point.
Especially considering RBC's target of $14 and the intrinsic value of their contracted backlog.
The market is currently valuing the company based on fear. Fear of the arbitration black box and fear of future spot prices.
Right.
But if you value the company based on its $6.3 billion in adjusted EBITDA, its unmatched modular construction speed, and the backing of the world's largest banks.
That $12 price tag starts to look wildly inefficient.
It really does.
To recap our ultimate takeaway today, Venture Global offers a genuinely rare asymmetric opportunity.
Yeah.
We're looking at a wildly misunderstood high-growth infrastructure play. They are churning out $6.3 billion in earnings.
While executing logistically on a global scale with 380 record cargoes.
And they have secured $20.7 billion in validation from the biggest banks in the world.
And yet the stock is trading at a steep discount, purely due to the noise of standard commercial legal disputes.
It is the definition of a fundamental reality disconnecting from market sentiment.
Over a long enough timeline, the math always wins out over the sentiment.
Which leaves us with a final, provocative question to ponder.
What's that?
We started this talk by marveling at how a company could pull off a garage to Fortune 500 transformation practically overnight, only to be ignored by the market?
Right.
If the broader market is aggressively mispricing a $13.8 billion cash generator simply because it is entangled in scary but ultimately manageable commercial headlines, what other high cash flow infrastructure plays might be hiding in plain sight within your own portfolio, artificially depressed by the news cycle?
That's a great question.
Something to think about as you review your holdings this week.